I'm Russ Mould, AJ Bell's Investment Director, and I'm here to discuss the subject of exchange-traded products, ETPs, and how investors can use them to build a balanced portfolio. With me is Pav Sharma of ETF Securities, one of Europe's leading providers of exchange-traded products, and we're going to look at the different types of ETPs and what you need to know about them. So thank you for your time, Pav.
Thank you.
Now, before we go any further, lots of people will hear the word fund thrown about with gay abandon. So can you explain the difference between a passive fund, an active fund, and where ETPs sit, as it were?
Sure. Okay, so let's start with the investment methodologies then. Active management is aiming to outperform a given benchmark. So take the FTSE 100. An active manager will be looking to outperform that benchmark. In contrast, a passive product or an ETP, for example, which are generally passive products, aim to track a benchmark. So all we're doing is looking to replicate the returns.
Right, so there's no fund manager at the passive product trying to, again, pick the stocks or pick some, not others. It's a broad brush approach designed to mirror the performance of the underlying.
Exactly. All passive products are doing is they're tracking an underlying benchmark. What that does is raise a question. Well, why would you go for one over the other? Yeah. I mean, the key point to remember is it boils down to what your investment objectives are. But if we look at the active management industry, generally costs are much higher, so you're paying for a level of expertise. If we take the UK or the US equity markets, very often the active manager actually fails to outperform his benchmark. That's quite common. So in that instance, a lot of people are looking at passive instruments as low-cost alternatives that are actually providing, decent returns.
So there can be quite a big gap in the cost structure. I mean, what sort of degree are we talking about in terms of basis points or percentage points?
Well, I mean, it really varies according to the underlying exposure.
Right.
But take the equity market, for example. FTSE 100 ETFs today are coming in at below 10 basis points, so below 0.1% annualized, exactly. So it's incredibly low. When you look at those products, they're very low cost, but they're actually outperforming active managers charging more. And so in that case, the argument for passive investing and the argument for ETPs, generally is really quite compelling.
So that's the difference between an active fund and a passive fund. Now, there are different types of ETPs out there as well, aren't there? So what's the difference between an ETF and an ETC, for example?
Yeah, it's a bit of a jargon bust. There's lots of acronyms out there. ETP, or an exchange-traded product, is just an umbrella term, like you said.
For all of them?
For all different types of legal structures that we use. ETFs, they're just funds, open-ended funds that issue shares and they trade on exchange. Generally in Europe, they're what's referred to as UCITS.
Which is European regulation.
Exactly, it's a form of European regulation. So UCITS are undertakings for collective investments in transferable securities.
Very good.
Bit of jargon busting there. But essentially the key point to make is that ETFs, your UCITS funds generally, they're diversified. So generally they can't hold any more than 20% of one single asset. So by the very nature,
they have to own more than at least 5 secure underlying securities, doesn't it? I think.
Exactly. So by their nature, they're diversified. So that the question arises: well, you have ETFs. You can access equities, fixed income, commodities, everything via the ETF, ETF vehicle. Well, why do we have ETCs? ETCs, they're not UCITS, so they're not restricted in terms of that diversification requirement. Exchange-traded commodities and currencies, for example. So what ETCs can do, they can offer access to very specific exposures.
So just one underlying rather than a basket. That's the big difference.
Exactly, and that's the key point. So you can access physical gold, silver, a currency pair via an ETC, whereas you couldn't do that through an ETF. And so that's why we have ETCs in the market. They're structured slightly differently, so they're not structured as funds, but essentially, the aims are exactly the same. All these products are looking to do is track an underlying benchmark.
So from an investor's perspective, if they were to decide that one of these fitted with their strategy, time horizon and appetite for risk, for example, would it make any difference to them in terms of how easily they are to buy or sell, whether it was an ETF or an ETC, for example?
They're traded on exchange in exactly the same ways.
And stamp duty?
No stamp duty in either secondary or the primary markets. No stamp duty.
Perfect. Pav, thank you very much for your time.
Thanks,
and thank you for watching. And do please watch out for other videos that we have across the website.